Imagine landing that dream job you've been praying for. And now you're so ready to get that zoom you've always wanted. You head to the bank for a loan, but then they hit you with, "Sorry, your credit score isn't high enough." You're sitting there all confused because you know you've always paid your bills on time. Yet somehow your credit score is dragging you down? My darling, do you know that according to Equifax, a good credit score is usually between 660 to 724? And yes, this score can affect just about every financial decision you make, from buying a car to getting a house, and even landing a job in some cases. But wait, what actually is a credit score? How does it even work? Does it impact your life in any way? Don't worry, I'll explain. And listen, if you stick around, I'll show you 5 actionable steps you can take to start boosting your credit score immediately. So let's start with understanding what a credit score actually is. Simply put, your credit score is a number that tells lenders how likely you are to repay a loan. That's simple. Lenders use this score to decide if they'll approve you for credit and what interest rate you'll get. A higher score typically means you're less risky to lend money to, while a lower score means the opposite. But here's the catch. It's not just one score. You actually have 3 main credit scores, each coming from one of the big credit bureaus, Equifax, Experian, and TransUnion. Each of them has slightly different methods for calculating scores, so your score might vary by a few points, sometimes even by 30 points between them. So what actually goes into your credit score? Because credit scores aren't just random numbers. They're calculated based on a mix of key factors, and some carry more weight than others. Now, here are the 5 main players shaping your score. First is your payment history. You can think of this as your track record. Lenders simply want to know if you've been paying your bills on time. So your credit cards, student loans, car payments, etc. They just want to know how reliable you've been. Because late payments or accounts sent to collections can actually drag your score down. Number 2 is the amount you owe. This one's all about your debt. You see, lenders want to know how much you owe in relation to how much credit you have available. This is called your credit utilization ratio, and the lower it is, the better. For example, if you have a credit card with a $10,000 limit and you've racked up $8,000 in debt, your utilization ratio is 80%, which is considered high. Ideally, you want to keep your utilization under 30% to maintain a healthy score. Next is the length of your credit history. Here, time is your friend. The longer you've been using credit, the more trustworthy you look to lenders. Even old accounts you're not actively using can help, so don't rush to close them. They add history and show stability. Okay, lovelies, if you're finding this helpful, please hit that like button so the algorithm can push this video to others looking to improve their finances. New credit. Yep, you heard that right. Every time you apply for new credit, it's considered a hard inquiry, which can temporarily lower your score. So if you've been opening a lot of new accounts in a short period, lenders might see that as a red flag. It suggests you might be taking on more debt than you can handle. And finally, credit mix. Having a mix of different types of credit like a credit card, an auto loan, maybe even a mortgage, simply shows lenders that you can manage different kinds of debt. But please don't go out there and open accounts just for the sake of it. It's all about showing you've got a handle on what you already have. Now that we know how credit scores are calculated, let's talk about how lenders actually use them. You see, lenders rely on your credit score to gauge the risk of lending you money. As mentioned earlier, a higher score tells them you're likely to pay on time. This increases your chances of approval and can even land you a lower interest rate. It's a win-win. On the other hand, a lower score can make lenders hesitant. They might deny your application, or if they approve it, charge a higher interest rate to offset the risk. Now, it's worth noting that not all lenders use the same scoring model. FICO is the most popular, but others, like VantageScore, exist too. While the methods might differ slightly, all models focus on the same key factors we just covered. So, you know how your credit score is calculated and how lenders use it. But here's the big question: what can you do if your score isn't where you want it to be? Don't stress. Just follow these 5 actionable steps to start boosting your credit score today. Number 1, pay on time. This one's huge. This one is important because payment history makes up 35% of your score, so staying on top of your payments is non-negotiable. Set up automatic payments or calendar reminders to make sure you never miss a due date. Number 2, reduce your debt. Tackle high interest debt first, especially credit card balances. Your goal should be to lower your credit utilization ratio, ideally to under 30%. This can give your score a noticeable boost. Number 3, keep old accounts open. Still get that old credit card in the wall safe? Keep it open. Yes, my darling, keep it open, because a long credit history works in your favor. Trust me, just make sure it's not costing you any fees, and you're good to go. Number 4, be mindful of new credit applications. Avoid applying for multiple new credit accounts in a short period. Each application triggers a hard inquiry, which can temporarily lower your score. Only apply for credit when it's absolutely necessary. Number 5, check your credit report regularly. Believe it or not, errors actually happen more often than you'd think. Make sure to review your credit report annually for mistakes or signs of fraud. You can get 1 free report per year from each of the 3 major bureaus, and if you spot something off, dispute it right away. And there you have it, guys. Don't forget to subscribe to the channel and hit that like button if you enjoyed this video. Take care, lovelies, and I'll catch you on